So we do want to just bring attention to a few housekeeping items. One, the Q&A box, the Q&A feature. One of our participants is well acclimated with that feature since they've already submitted their shout out for their favorite team. But this is a collaborative experience. We do want to have any feedback from what you're experiencing from our conversation this afternoon. So please fully utilize the Q&A box on your Zoom feature. Feel free to raise hands if you have questions. We do want to address anything that comes to mind as we go through our conversation today. If you are experiencing this for the first time, my name is Marcus Rather, and my business partner here, Emmett Corboy, we're both financial advisors here in the Richmond area. We are taking this moment to recognize Life Insurance Awareness Month. Life insurance is a key financial tool used in financial planning, and I'm very excited to introduce this topic because so often do we have educational experiences focusing on the offense of financial planning, which allude to things like investing, asset management, saving and accumulating assets for major life phases, whether it's retirement, college, major expenses in life. But we also want to recognize the value of defense, a strong defense that can help propel an offense. The defense within financial planning typically is risk management. And one of the most useful tools in defense is that of life insurance. So our goal is to help you as you enter or experience all of your different life phases, which is really the context of the conversation that we'll be having today, is understanding the life phases that you have and where life insurance can be used throughout all of those different life phases.
You're gonna have to bear with me. I'm on the clicker this month, so I'm a little bit slower than Marcus with that. So.
Yeah, we got a little bit of change of responsibilities, but and follow up with the phases of life. I want you to take a moment and just think of where you are in this phase of life, right? I want you to take a moment and just think what you've experienced before, where you are now, but also where you're headed. So whether you're someone, like myself, single with few responsibilities, and within my financial plan, it's just me, right? So my financial plan is centrally focused around myself. But at some point in time, I may experience a life phase or change where I start to settle down, buy a house, and have children, right? So, my financial plan are going to include other people. So as I experience, changes in life, you also may have experienced the same where, you developed a family and you're coordinating benefits with a spouse, but you're also creating a lifestyle for children. And as they've gotten older, as they're getting older, you're thinking about the life ahead for them, which can lead to them becoming fully independent or going into the work field, or it can lead to them going into college where you're still providing some level of support for your dependents. And what's vital there is just things like income protection, because your income creates the lifestyle that you're developing, not only for yourself, but also for them. But maybe you're someone that's entering into a phase of empty nesting, right? Children are now grown, fully independent, and they very well may be starting a family of their own. But you're thinking about the next phase of life, whether you're focused on, entering into retirement and prayerfully entering into retirement without a mortgage, or, on the final stages of paying that off, and thinking further into retirement, just the life in retirement, and you're mainly only concerned about final expenses, making sure that your retirement income lasts as long as you do, and making sure that those assets can be passed on. So clearly, as you can see, that there are different phases of life that you're going to experience. And with those different phases of life, you're also going to have a change in your responsibilities. And so often people overthink or overlook, rather, the change in responsibilities, as well as a change in their personal finances, whether it's income that gradually increases throughout your professional career, the value of your assets and the value of your portfolio that grows over time. As those things continue to evolve and change, it's beneficial to just take inventory of the stage of life that you're currently in and where you're, possibly headed.
So if I could add one thing on this real quick, Marcus. Mm-hmm. So when we look at this just kind of from like a graphical sense, like when you look, and these are supposed to be straight lines, bear with me. Usually when somebody's at this, single few responsibilities side of life, their needs are pretty low. But then as time goes on, those needs start to kind of go up and can even skyrocket before they end up plateauing and then, eventually kind of going down. The reason why I don't ever show that as, zero need though, is because, there always is kind of a need for, protecting final expenses. We never want to make sure, we always want to make sure that, those last minute costs, whether it's, funerals, burial expenses, that sort of thing, or, any medical expenses that may arise aren't passed on to any survivors should something happen. So that's kind of, if anybody's a little bit more of a visual learner out there, that's, a visual way to kind of look at that, path of what we go through in life in many circumstances, and everybody's situation is different. Not everybody buys a house or gets married or has kids, but, as time goes on, all of our, needs for life insurance kind of change at, our different stages as well. So I just wanted to kind of add that in there as well.
Thank you for adding that, because one of the points that's going to come up as we continue through this conversation, it's going to be the difference between long-term needs and short-term needs, which I think is going to add value to some of the context we'll be sharing about how to view life insurance as a portfolio and as a financial asset. So understanding why you need life insurance, right? So some of the typical needs that come up in conversations that we have in working with our clients are, again, funeral expenses, making sure that, the inevitable, right? Two things are for certain: death and taxes. So when the inevitable occurs, making sure that, final expenses are provided for, whatever type of experience you prefer to have, whether it's simple as, just a cremation, or if you prefer to have a celebration of life. We want to make sure that expenses can be covered for anything associated with the funeral, but also eliminating any type of liabilities that may be shared with a significant other or just in your name. Things like a mortgage, or maybe a car loan, or any outstanding student loan, or any other form of debt that may be remaining. Typically don't want to have that pass on to a loved one or a family member. And as we talk about dependency, if you are someone that's providing some level of care, whether it is for a dependent or maybe a parent or a sibling, if you're someone that's providing a certain level of resources, you always want to replace that loss of income should something happen to you in your working years or even in your retirement, because typically what occurs is when someone passes away, you have that loss of income. And if it is important to leave an inheritance, leave a legacy to your family, or providing any resources for paying estate taxes, a lot of these needs, as we're discussing them, are needs for the benefit of someone else, right? But as you can also see, if we switch to the next slide, life insurance can also be a what's in it for me type of benefit. And the what's in it for me type of benefit can be things that benefit you as you continue to experience life, whether it's a way to leverage any tax liability through the accumulation of assets that can be used on a tax-free benefit, or if it's providing resources for long-term care, which is something that's a growing development within the insurance industry as we continue to have older people experience chronic and critical illness and changes in their health. The ability to provide resources to provide that level of care that they need. Life insurance can be a tool that's used to help offset any expenses incurred from a long-term care or chronic illness type of scenario. So why do you need life insurance? Again, it can be from a needs-based perspective for the benefit of those that matter the most, those people that you are providing care for, that you love and cherish, or it can be in a what's in it for me type of standpoint, something that benefits you much later on throughout your financial plan. So from the context of, again, the value of income, I want you to take a moment, and again, with the phase of life that you're in, take a look at, how much income or resource you're providing for the benefit of your family, whether it's children, spouse, significant other, or family member, some other family member. I want you to take a look at the power of income, right? So if you're someone that's making 50, or you have a household that's making 100 or even $250,000 per year, I want you to take a look at, what that accumulates to, depending on the years of work that you're eligible to receive. So if you're someone, just starting off of the far column here, $50,000 over 40 years, that's $2 million of earning potential that you would have, right? if it's simply just 5 years leading into retirement, that's down to even 250,000. And you can see as the graph goes along, the more income that you make with the appropriate amount of years, there's a substantial amount of money. So if you're, a household is making $250,000 per year, and you have 40 years of earnings 40 years to earn that income, well, that's over $10 million in earnings. And so often do we experience, people saying, well, I have coverage through work, right? I typically get 1 times, 2 times my salary. And one of the tough questions that we used to ask was, well, if you had to trade what you have in death benefit from work, that 2 times your salary, how long would you be able to live if you could no longer work a day in your life, right? If you simply had that $100,000 to last you for the rest of your life, how far would that $100,000 or $200,000 go? The reason we ask that question is because, again, when you experience that change of life, right? When someone passes away, not only do you lose that person, but you lose the income that they can provide. So when we say, again, looking at the most valuable asset, we also want to make sure that as you're looking at the cash needs of funeral expenses, the cash needs of paying off debt, paying off a mortgage, or just simply leaving an inheritance, we don't want you to overlook the value that your ability to make an income can provide.
Yeah, I think so often, just to kind of piggyback on that, Marcus, so often we hear people say, oh, well, the house that I live in, my home is my most valuable asset. Not many people out there walk around without homeowners insurance or without some type of protection on their house. But also, I don't know too many people out there who are living in $2 million, $3 million, $5 million homes either, right? But when we look at this, again, look at some of these numbers where if there's somebody who makes $100,000 a year and they've got 20 years left to work, that's $2 million that they're, projected to earn over the course of the rest of their career. Not even including raises. That's just 100,000 times 20, right? So what really is your most valuable asset? Is it your home, or is it your ability to earn an income, right? We'll always want to make sure that we, protect our assets. Life insurance obviously is, the topic of tonight's conversation, which is one way that we can protect that, ability to earn an income as well.
Yeah, and I think we would, if you remember anything from that, just think economic value, right? I think we would call that your economic value, your earnings potential between now and to, and even possibly through retirement is your economic value. And with respect to the value of your home, no one, will underinsure the value of their home, right? Full coverage for the full value.
Right.
So often do people undervalue their earning potential and their economic value. So as we go into the next slide, how much life insurance do you actually need? That's a simple example, right? That's a rule of thumb. At the end of the day, the amount and the type isn't right or wrong until it's put into the context of your own individual situation, right? So as you look at your personalized needs, as you look at your responsibilities, the people that matter, the charity, the business that matters, that's going to determine how much insurance you need. So whether you're figuring, final expenses, providing resources to pay off a mortgage or any rent that you may have outstanding, eliminating debt, providing resources for childcare. As you can see the bullets on the list, again, these are examples of things you may want to consider. But again, the amount is going to depend strictly on, you and your individual situation.
Well, this clicker doesn't like me. I don't know what's going on.
So if we're sticking with that needs-based approach, as you saw some of those needs from the previous slide, we do want to associate some of these things from a long-term and a short-term perspective. And the reason that we encourage this viewpoint from that needs-based approach is very often do we get the question, which one is better, term or permanent, right? And for me, and I don't want to immediately speak for Emmett, but I believe Emmett shares the same sentiment. Again, the amount and the type isn't right or wrong until it's put into the context of your situation. So all that to say, it's not a matter of which one is better than the other, because at the end of the day, you can reasonably have both. They both have a place. So whether you're using a permanent solution to cover short-term need or long-term needs, like, again, funeral expenses are always going to be a thing that we have to account for. Taxes are always going to be something that typically is going to be an expense that you incur from whether it's property, passing on of assets, so on and so forth. As you can see, long-term needs are things like your burial or final expenses, the income needs replacement, leaving a legacy, or experiencing chronic or critical illness. Those are typically things that can be a long-term type of need, but some of your short-term or temporary needs are things that typically have an expiration date, right? Maybe you have a 30-year mortgage or a 15-year mortgage. Student loans, you may be a part of a forgiveness program or part of the 20-year income-based repayment plan. Car loans have an expiration date, so on and so forth. So as you look at the type of needs that you have, you essentially want to build an insurance portfolio that can satisfy those needs. So it's never just a one and done type of scenario. It's not a one and done conversation because your needs and responsibilities change through life, but it's typically not a one and done solution either because all of your needs may not feasibly fit a permanent or a temporary type of solution. So with that explanation of long-term and short-term needs, we do want to just briefly explain the different types of insurances that are out there so you have an understanding of the difference. But keep in mind, you want to build or develop an insurance portfolio.
Yeah, absolutely. So Marcus, thanks for, taking us through kind of, why insurance is important, why life insurance is something, important to look at in pretty much every situation out there. There are different ways to kind of go about it. And, two main broad categories of types of life insurance. One is what's called term life, and the other is permanent life. And so we're going to get into these in a little bit more detail, but think of term life kind of like renting, right? When you rent a house, an apartment, whatever it might be, generally speaking, you've got a lease, right? And you can live there as long as your lease is up, right? And sometimes you can even stay there after on a month-to-month basis or that type of thing. But, what generally happens at the end of your lease is you either have to renew it or you have to move out, right? And your landlord's not going to be real nice and give you back half of the rent that you paid. You basically don't get anything back at the end of your lease, right? What you paid in rent just goes to the landlord or apartment complex or whoever it may be. Term life is very similar. Difference is your lease isn't 12 months or 2 years. It's more like maybe 10, 20, 30 years, somewhere in that department. At the end of that period, if you're still alive, congratulations, you lived through your life insurance policy. That's a good thing from the insurance company. So it's basically just you're paying a premium for coverage, right? And so we'll get into that in a little bit more detail, but I wanted to give that analogy. Permanent life insurance is more like buying a house or buying, a piece of real estate where month by month, you've got to make that mortgage payment. With a life insurance policy, you've got to pay a premium for the coverage or for the policy. But part of what you pay toward a mortgage not only goes, for your place to live, but it also builds up some equity in the property for you, right? We've seen that a lot over these past couple of years. Real estate values have kind of, been driven up and up and up with the recent housing boom. So, folks have more value in their homes now than they may have, 3 years ago, 5 years ago, heck, in some situations, 30 minutes ago, even in this day and age. But, with permanent life insurance, you build up something called cash value. And so we'll kind of talk a little bit more about that as well. So with term life, your big advantage is low initial premium. You don't have to worry about, having a high cost or anything along those lines. And when we look at what's the way that I can get the most coverage for the least out-of-pocket expense, term life insurance is going to be the best way to go, right? And that's why it can be really ideal for those shorter term needs, for temporary needs. And a lot of times, you can kind of renew that as time goes on. One thing I will say is, term can really kind of match pretty well with some goals. Let's take a mortgage, for instance. If you've got a 30-year mortgage, well, you can take out a 30-year term policy that protects the amount of your mortgage for that 30 years. Now, not every situation is perfect where a mortgage is actually paid off after 30 years, but you can have that protection in place for the planned amount of time. The not so good thing with term life insurance is that if you go to renew after a policy expires, your premium is going to go up. And some policies are actually built in to where it goes up, over different periods of time. There's no benefit payout if you outlive the policy, kind of like that analogy I gave with, renting versus buying a home. And, you don't build up any sort of cash value within the policy either. Permanent or cash value life insurance, one of the big advantages is that it builds value over time. Also can provide funds to beneficiaries without depleting, an estate. Benefits for, the policy owner, which usually the policy owner is the insured, but it doesn't necessarily have to be, right? Benefit for the policy owner is tax deferred growth, meaning that cash value within the policy builds without you paying taxes on it year over year. And then there's potential for that to be withdrawn, during the owner's lifetime, during the insured's lifetime, at a tax-free basis as well. Caveat I have to say here, I'm not a tax advisor. Marcus isn't a tax advisor, but we do kind of know the tax ramifications with regard to life insurance. For specific advice on your situation, consult your tax advisor for sure. But those are some of the advantages. Another big advantage to permanent or cash value life insurance is that it's going to be here as long as you are, right? You control how long this policy is in force, right? If you want to have it for forever and ever and ever, make sure the premium is paid and it'll be, in force for forever and ever and ever. And the reason why that's, beneficial, like I said, there's always going to be, some sort of final expense need that we all have. We know that we're not making out of this world alive. And so it's important to have at least part of the insurance portfolio that's programmed to be here as long as we are. Not so good thing, or the downfall with regard to permanent or cash value life insurance, is that it's going to be a much higher out-of-pocket cost, right? When you look at the same, death benefit or face amount, the term policy, might be, say, here from a premium standpoint, a permanent policy might be here from a premium standpoint. So it's much more expensive on a month-to-month sort of basis. And there are different types of, permanent or cash value life insurance. Probably the most popular type and the first type is what's called whole life. Some of you might be familiar with that term, whole life insurance. Again, benefit with that is that it's tax deferred growth, tax-free income. And another key benefit here is that you've got a guaranteed premium and a guaranteed death benefit. You know that your premium and death benefit aren't going to change at all. So it can build in some predictability within your budget over time, within your finances and your financial plan over time. The disadvantage is that most whole life policies, the way that it grows is with interest rates. Now, when we look back 30 and 40 years ago, interest rates were a lot higher than they are now. So a lot of these whole life policies were paying a much higher interest. Now, they're not paying near as much, right? So over time, they might not keep up with inflation or grow as much as some other investment opportunities that exist out there as well, right? Whole life can be a good piece of an insurance portfolio, an investment portfolio. By no means do I say that it's a one-stop solution, although you may hear that from certain points of view. Another permanent life insurance solution is what's called a universal life. One of the great things about this is flexibility, right? So with universal life insurance, you've got flexibility built into it. You can decide really how much you want to pay into it, flexible premium, And the death benefit, you've got some, flexibility with that, in that you can decide if you want that to stay level or if you want that to kind of increase over time, right? On the surface, you might say, well, of course I would want it to increase over time. But it depends, it depends on if you're taking out this policy more for the death benefit and protection, or if it's more for, cash value growth, right? If you're taking this policy out more for yourself to build up cash value, right, it might be a different answer than if you're, using this for family planning or estate planning or that sort of thing. Sometimes when I say, well, you can decide how much you want to put into it, the initial reaction that I get all the time is, well, I'm going to put in as little as possible. Okay, well, then that means you're, going to build only a very, very small amount within your cash value. So, Marcus, is it okay if I do another drawing here? Okay, I'm going to actually use Zoom's tool that allows me to draw straight lines this time. And hopefully this will be a little bit better. Of course, now this wrench is going to get in my way. It's really throwing a wrench in my plans here. Let me go over here. Dad joke, I'm allowed. I've got two now. All right, so with universal life insurance policy, one thing within the policy that happens is you've got a cost of insurance, and that number changes every single year. So your cost of insurance goes up year over year, basically the amount that the insurance company charges you to have the policy in place. And by no means is this drawn to scale at all, but this is just, kind of a, rough figure here, something that you can keep in mind for illustrative purposes only. So when you think about a flexible premium, usually, folks that I speak with want to plan to keep that about the same year over year, month over month, whatever it might be. So we'll just draw that premium line straight. And when you look, you can see that initially you're putting in a lot more than what that cost of insurance is. And then later on, you're putting in actually less than what that cost of insurance is. Well, in the early years, that difference goes to build up called the cash value, right? And that is what, is available for you during your lifetime. During the later years, you can see, it might be taking from the cash value to keep the policy in force. One of the big differences between whole life and universal life, whole life is guaranteed for your entire lifetime. Universal life can potentially lapse, right? So if your cash value is, not well funded and your cost of insurance is going way up, then that cash value can, go to zero potentially and can cause the policy to lapse. So it's very important, especially if you have older universal life insurance policies, to review these to make sure that you're in good standing. Because what happens is, like I said, a lot of times folks plan on paying one cost or one premium, but then maybe they, lower that down at some point in time, or, something happens and they have to pull out from the cash value, which, is accessible, but that can just, eat into potentially what you have down the road as well. So one strategy that we look at pretty often actually is actually paying in more than what that, planned premium might be, which what that does is it gives you the ability to build up more in cash value to, allow the policy to grow greater for your own, lifetime as well. So we certainly, can get deeper into that on a one-on-one type basis. I just want to kind of introduce that concept a little bit as well. Other benefits with cash value life insurance, like I said, the cash value accumulates tax deferred and you can access that tax free. There can be a dividend payout and you can have different options on what you do with that dividend. You can, have it increase your amount of coverage, or you can have it reduce the premium that you pay, or you can just get a check in the mail and take that check, for your dividend. You also, one of the big, benefits of cash value insurance is that you can take a loan from your policy, and you can access that, during your lifetime. Additional benefits, there is a lot of policies come with the option to build in what's called a waiver of premium rider, where in the event that the person who's paying the policy or the insured becomes disabled during that premium paying period, the waiver of premium will start to make that premium payment for the insured. So it allows the policy to stay in force without, having to pay the premium. Another huge benefit, and something that's, become a lot more necessary and popular over these last few years, is an accelerated death benefit. Like we said, we typically think of life insurance for our survivors, but an accelerated death benefit allows us to access the policy face amount or death benefit during our lifetime for certain criteria. One of the biggest ones right now is for long-term care, right? Where, we'll get into kind of some examples on that, but that can be a huge, benefit to cover what can be really an exorbitant cost in the event of an assisted living facility, nursing facility, or even just a nurse coming into a house and helping out with, care needs later in life. Another option that we can add on to a life insurance policy could be an accidental death rider as well, which would pay out an additional 1, 2, 3 times worth of death benefit in the event that the insured passes away during an accident, or due to an accident, I should say. So that's a bit of kind of the different types and, kind of the ins and outs there. Marcus, do you want to start walking through some of these cases that we have as well?
Yeah, absolutely. So at this moment, I do want to just stop because, we have been going on for quite a few minutes. So if you do have to, leave, we greatly appreciate you joining the presentation to this point. I will say a lot of what we presented is the science behind understanding the context of life insurance, but we wanted to take a moment to really show you how life insurance is applied. So just a disclaimer for some of the cases that we're going to be discussing. These are real solutions. Now, what's not real are the names. A few of the numbers have been adjusted just for context of some privacy. But the situation or the scenario are real life scenarios in terms of needs, solutions, so on and so forth. So we did want to just share a story, really, just show you how, what we're introducing or what we're educating, how that can be applied, and just gives you some food for thought for your own situation. So the first scenario here, it's a juvenile policy. This client unfortunately lost his wife back in a few years ago. So now he's, providing for their daughter, and he took a moment to just take a thought and to say, well, I've already experienced loss before, and should something happen while she's traveling with, grandma over the summer. What shocked me in the story really was he said if something happened to her, he wouldn't be able to work. So, he wanted to make sure that should something devastating happen to him again, that he would at least be able to take care of the home. So he wanted to make sure that not only is it a policy that can grow value over time, something that could be used much later down the line for her benefit, he did want to make sure that the benefit amount could take care of his grieving process. And I thought that, just spoke volumes. So the solution that we found for this policy was a variable universal life policy. The reason we went with that solution was because, again, the flexibility to pay more into the policy, either at the beginning or later on in the phase. He really valued the usage of the cash value growth, and he wanted that to grow. And from an investment standpoint, he wanted that to grow rather aggressively. So the solution that we found was indeed a $200,000 variable universal life policy. And it really fit into the needs that he was looking for. It provided him the peace of mind that, God forbid, if he had to grieve, the loss of his daughter, that he could do so without the concern of paying his mortgage every month. While in the meantime, prayerfully, she lives a very long life. So there's going to be some cash value accumulation that she can use on into her adult years. The policy comes with a no lapse guarantee. So with all of that flexibility, as Emmett had mentioned, universal life policies may run the risk of lapsing. Well, this policy comes with a no lapse guarantee. So she's going to have this policy whether there's cash value accumulation or not. And because she's a juvenile, it came at a preferred rating, meaning the premium costs for the policy are cheaper than it would be if she were a young adult. So we wanted to just share the context of that. I believe, many parents do not want to think about the thought of, them losing or burying their child. It's a very uncomfortable thought, but, from, I believe, Emmett and I's experience, we've seen our unfortunate fair share of, people passing away unexpectedly. So that was a solution I just wanted to share. It was something that I just wanted to give you some food for thought if you're someone that has dependent children and possibly looking at, providing a policy with the thought in mind that, you also want to think about grieving as a reason to have a financial need.
Yeah. And another important thing, and we'll kind of see this in the next case study, what this does as well is it protects that 9-year-old's insurability, right? I don't know about you guys, but I know I was probably in a little bit better shape when I was 9 years old than when I was, even 29 or the age that I am now. Now, thankfully, I don't have any major health issues or anything along those lines, but who knows what the future holds, right? So the premium that is paid on this policy is built in on, the cost of insurance when she's 9 years old, right? And the reason why that can be so important is when you look at this next case, you can see this person, we start looking at a situation with a 25-year-old male. We'll use the name Kevin here. At age 25, he was in, pretty standard health, didn't have a spouse, didn't have any children, no, real big financial needs, had some student loan debt, some, final expenses. And, from a death benefit protection standpoint, maybe just, in the event that God forbid something happened to him, we wanted to make sure there was enough cash for his parents or siblings. So at that point, Kevin took out a $100,000 whole life policy. And if we fast forward 20 years into the future, thankfully, Kevin's still in good health. But at this point, his family life and his responsibilities have changed. If you remember that first bad drawing that I put up where, as we start off in life, our needs are lower. Time goes on, they kind of go up and then, they kind of go down. Well, Kevin's probably at that point, like right around here or so, where, now at age 45, he's married, he's got 2 kids, he's got a mortgage, right? He's concerned about his kids, college education. He's the primary breadwinner and he needs to make sure that should something happen to him, that there's, funds available for his wife to replace his income as well, right? So when we look at that total need, you can see that that's built up to, about $1.1 million, right? And, thankfully, again, like we said, he's got that 100,000, whole life policy in place already. He also has 2 times his salary through work in what we call a group term policy. As long as he works there, he's got that $200,000 of life insurance. If he changes jobs or when he retires, usually that just kind of goes out the window, right? In fact, pretty much every situation that's gone. So, what we looked at here was adding in an additional $800,000 of term life insurance. And, you can do this for up to 20 or 30 years, right? So, I don't know of many policies out there, although you might be able to find some that go beyond 30 years. But when we look at this situation, in 20 years, Kevin would be age 65. If he wanted to make sure that he made it to retirement, that might be a good solution for him. Or if he wants to get a few years further in, a 30-year policy would take him out to age 75, right? Which, that's going to be getting him to the peak of that curve and then probably down, some as well. And one way that we do that a lot of times is maybe rather than having all 800,000 all in one policy, we might have 400,000 in a 20-year policy and 400,000 in a 30-year policy. So we kind of blend it together. Like Marcus talked about earlier, as your needs maybe fall off, maybe some of your life insurance can as well. So it's one way that then, potentially entering into retirement, his, expenses might drop slightly with that 20-year policy, falling off as well. And by the way, if you guys have any questions on any of these as we're going through, definitely use that Q&A box also.
Yeah, so the third case study here, somewhat of a what's in it for me type scenario. So we had a 35-year-old woman, we'll identify as Florence, standard health. She recently had gotten engaged. So prior to being engaged, her needs were, again, focusing on what's in it for me. So final expenses, she had just incurred a new mortgage, that, new home with the fiance, and she wanted to develop tax-free assets in retirement. So her saving situation, she's a high earner, and she is taking full advantage of the employer match with her 401k, but she's also maxing it out with the maximum amount that she can put into the retirement plan. So with her income, she actually exceeded the amount of what she's eligible to contribute to a Roth IRA. So the emphasis of, really developing a tax-free asset in retirement, with the, unfortunate option of not contributing to a Roth IRA, that was a little bit of a challenge. So the total need for her was $400,000. Now, the solutions here are pretty simple, right? One, she can do, just the bare bones minimum of taking care of the need. So she can do 100% term and just get a $400,000 term policy. The lowest cost option that satisfies the need. But what it doesn't accomplish is developing that tax-free asset in retirement. She could go the 100% permanent route, right? And go, everything into a permanent solution. And what that does accomplish is tax-free assets in retirement, as well as taking care of the full need. But she wasn't quite comfortable with the cost of a $400,000 permanent type solution. So what we did was we met in the middle, right? We developed a good portfolio of insurance where 150,000 could be for permanent. That still provided that asset accumulation and a tax-free asset. And we layered in a 30-year term for 250,000, which got her that total coverage for 400,000. So it really, satisfied all three categories of her need, where provides the need for, God forbid, she passes away, provides the asset accumulation through the cash value of the permanent policy, and it was comfortable within her monthly budget. So again, just encouraging a perspective of looking at insurance as a portfolio and not just a one solution or one stop drop type of scenario.
Awesome. Yeah, so with our fourth of 400 case studies, no, only 5. You guys we're wrap it up here in just a few minutes. But, this is a situation we just want to, like we said, just cover a few different situations here. So this is one where we've got a couple that's nearing retirement. You can see Roger is 58 years old. Marie is 55. Together, their household income is about $150,000 a year. And, their main needs covering final expenses, like we've talked about, taking care of, what limited mortgage they have left. But more importantly, probably is, replacing income, and also, making sure that if there were a time down the road, hopefully, where there was a long-term care or a chronic or critical illness that came about, that they had funds available for that, right? They also wanted to make sure that they, were able to, leave a legacy, especially to their young grandchildren, that they had as well. Here's another situation where, it's good that they had some coverage in place already. And the reason why is, they've got, they have $50,000 worth of whole life protection in place. That's able to stay in place just to, again, make sure that they've got that base of permanent coverage to cover those final expenses. They also, though, had $500,000 worth of term life insurance as well. And what they were able to do with that term life insurance is convert that to a permanent policy or actually what they did was convert a portion of it. They didn't take the whole 500,000, but they converted 200,000 each from term to permanent. A lot of term life insurance companies allow you to, convert, and, that allows you to, again, use the insurability that maybe you had in the past. And, when you look 10, 20, 30 years down the road, you might not be in the same health situation. You can convert your term to a permanent policy down the road as well. And in this case, they were able to add a rider on there for long-term care protection as well. So it was a way for them to, take what they had done years earlier and expand on it and build on it to get it to the point, that now they're getting ready to transition into retirement in about 5 to 10 years. And, they want to make sure that their insurance portfolio is positioned well, not just for right now, but also for what they might need throughout those retirement years as well. And then the remaining $300,000 of term life, keep that in place and keep it for the next 10 years. When, again, hopefully those needs will kind of be coming down, in that time frame also.
So with this last case, this is Uncle Phil and Aunt Viv. Shout out to those that may catch the reference. But just using names from my favorite TV show, Fresh Prince of Bel-Air. But this is a scenario where they were both retired. One had retired a few years ago. Aunt Viv retired in 2022. Their needs were, again, final expenses, income replacement, but they were also thinking forward about providing resources for chronic and critical illness. Now, this scenario has some other extra details. The one detail is that they are comfortable with income from pensions. Pension and Social Security satisfies all of their living expenses, but they've also developed a very substantial nest egg that may create some tax inefficiencies should one person pass away. If you know anything about taxes, right, we know about married filing jointly, but what most people are not familiar with is a change from married filing jointly to filing single. And as you enter into a phase where you're required to take minimum distributions, what they may be required to withdraw for one person could easily bump them up into another tax bracket. So there were some interesting scenarios about this case, but those were the needs. It was income replacement should one person pass away in retirement, or when one person passed away from retirement, chronic or critical illness should somebody have a health change, and they wanted to have some tax efficiency for their surviving spouse. So the existing coverage, they had, again, small policies already, $25,000 each to take care of the final expenses. And they have the retirement assets to make sure that there's that replacement of income. Problem is, those assets were located in pre-tax accounts. So things like IRA, 401k, and 403b, and they have the income to, again, last comfortably. So what the solution was, however, was to actually indeed purchase life insurance. Now, the reason I wanted to introduce this case is because if you're looking at their existing coverage and existing assets, you may simply look at that and say, what possibly more do they need? They have the income to live comfortably through retirement. They have the assets to possibly, provide for any long-term care scenario, and they have the policies to cover final expenses. Well, again, when we look at taxes, two things for certain: death, taxes. Those are two things that can really create an uncomfortable situation when that occurs. So the solution was to actually purchase a $300,000 universal life policy. And what that policy provided was, one, a tax-free death benefit. So, with the tax-free death benefit, what they would be able to do is a surviving spouse could indeed choose to either convert all the pre-tax assets into Roth, or to just help leverage or provide resources for any tax liability that they may face in retirement. Number two, this was actually a part of a pension maximization case. So what that provided was a flexibility for them to change beneficiaries, assuming that the primary insured lost their spouse, so they could change it to the next family member, a child, a charity, or whatever the case may be. Of course, with the universal life policy, there's tax-deferred cash value growth. So in turn, they're building a tax-free asset that can indeed be used later. But the policy does come with an extended care rider for long-term care. So what that does is it provides a monthly benefit of $6,000 to cover any expenses due to loss of two activities of daily living, which is deemed a chronic or critical illness. So truthfully, what this solution provides is all the flexibility in the world, the flexibility to choose how money is spent, whether it is used for chronic or critical illness, or if the benefit is used as a legacy play. It provides resources to help leverage tax liability. And if there is peace of mind of needing extra funds for whatever reason, if that $1 million were depleted, or if it had to be spent on one spouse for long-term care, it still provides resources for the other and providing benefits for a long-term care scenario. So that's pretty much the context of that solution. Again, if anyone has any questions about any of the cases that we went through or any of the information that we presented to this point, please feel free to ask those in the Q&A box.
Well, you guys are, maybe getting any questions together. In summary, what I'll say is think about, one, do I need life insurance, right? If so, how much do I need? And, then what type of coverage is best for you and for your situation, both now as well as your future self, right? We think a lot about, the present day, but it's important, especially, when thinking about your finances overall, to think about the future as well. So thinking about what type is best for me. So, we really appreciate everybody hopping on this evening. Obviously, Marcus and I are here to field any questions, both, right now, as well as probably more importantly, after tonight's event, right? When you have some time, you think through things, maybe, you open that bottle of wine, talk with your spouse a little bit more about, where you guys are at and what things are important to you from a family planning perspective, right? Maybe it's a good time to sit down and talk with Marcus or talk with me a little bit more about, what questions you have and looking at that overall situation as well. So there you can see, Marcus's contact info. We also, I'll just say this, in this day and age, I think everybody knows what these are, right? So if you want to book a time to speak with Marcus and go into this discussion a little bit further, you can scan that QR code as well.
Hey, Emmett, as we pause there, and again, the conclusion. So if you do need to leave, again, we thank you for joining us this evening. We do have a few, well, at least one question. What percentage of your salary or leftover funds should you consider investing in life insurance? I think that's an outstanding question, actually. I can't say I've gotten that question before. So just to repeat, what percentage of your salary or leftover funds should you consider investing in life insurance?
Yeah, that is a really good question. I've heard a rule of thumb one time up to 10%. To me, that's maybe a little bit on the higher side of things. Although depending on the situation, for higher income earners, 10% of their income toward life insurance can be a great situation for putting into cash value policies and that sort of thing. So, it really, kind of depends on what your needs are and what you're looking to accomplish. If you're looking at it strictly as an investment, generally I would want to say, take care of your, retirement savings like 401ks or, Roth IRAs, that type of thing first before you start, funding, especially a lot toward cash value life insurance. But yeah, that is a very good question.
Like I said,
hopefully that helps.
Yeah, I've got to admit that's the first time I've ever been asked that question. That is an outstanding question. So what I just encourage us to do is, if you have that question, it may be beneficial to, one, look at your needs, right? And then, look at your budget and just figure out the sweet spot in the middle, because, I understand that you still have other goals that you do want to accomplish. So before you do invest a substantial amount, you do want to just take in consideration other savings goals or other, priorities that you have as well within your financial plan.
Mm-hmm.
So with that,
Yeah, so I hate to give kind of a non-answer there, but it's tough to say like, exactly what amount or exactly what percentage. But it's really kind of a needs-based and case-by-case type of basis.
So with that, I believe that may have been the last question for the evening. So again, thank you everyone for sticking with us to this point. Prayerfully, you did find a lot of value. We will be following up and reaching out just to take any feedback that you have. We always appreciate your presence, but we also enjoy feedback. So please feel free to let us know things that you would like to hear from us. Maybe there's a topic that you would like to learn more or hear more about, or maybe there's a different perspective that you would enjoy. So please feel free to share any feedback that you have so we can continue to improve our experience. So without that, or with that, I'll bid you a good day, a good evening, and look forward to having you at the next one.
All right, we'll see y'all. Thank you.